The shorts are desperately creating a legal margin and illegal collateral to meet their margin requirements. Today I want to talk about how the shorts are becoming more desperate and more obvious with their illegal crimes. Stay tuned and let's make some money. I've spoken many times in the past about how hedge funds have been using stocks and pumping stocks to create additional margin to meet their margin requirements, but I think they're getting more and more obvious and they're exposing their true crimes. And now I want to dive straight in with the key information. So, Amari Faith tweeted about HKD or AMTD Digital. He said the stock ran from $17 to $900 plus, and it didn't experience a single halt and the buy button wasn't removed. The stock ran 10,000% plus, aka the stock increased in price by 10,000% and more within a single month with 170% institutional ownership. I think this ownership percentage was corrected by SkyCam, who had 147% institutional ownership per TD Ameritrade. Regardless of whether it's 147% or 170%, usually the maximum amount of something somebody can hold is 100%. Usually 100% is everything. But in the instance of HKD or AMTD Digital, it seems institutions are holding 147% of this stock. Therefore, obviously, institutions seem to be holding synthetic shares for HKD or AMTD Digital to obviously benefit from this massive run. And Rocket Astronaut said if this isn't proof the stock market is a fraudulent rigged system, nothing proves it. He said these shorts are buried under a massive amount of naked shorts and synthetics, and they've been stealing retail money. Now, many people have been speculating and saying, Tom, how did AMTD Digital or HKD run thousands and thousands of percent without experiencing any halts? How was the buy button not turned off, and how was this stock not stopped, and how did it manage to run so high without any intervention? But AMC to MULN tweeted this screenshot from Reddit saying, it all makes sense now. Somebody on Reddit commented saying this is a company with only 51 employees. They've got no financials available. They IPO'd out of nowhere around the same time as the GameStop dividend, and their market cap went from $1 billion to over $200 billion. One of the underwriters of the IPO is Loop Capital Markets, which has shown itself in several DDs with ties to Citadel. This post was also on Reddit talking about Loop Capital, the employer of Anthony Giacombra, who's the guy who regularly goes on television to bash GameStop and AMC. Loop Capital are the underwriters of this random Hong Kong company that's now in the top 20 most valuable companies in the world. You can see from this screenshot that AMTD Digital was underwritten by Loop Capital Markets LLC that previously has had ties to Citadel. On top of this, the corporate office for Loop Capital and Citadel's Chicago office is only a 4-minute walking distance. You can't short AMTD Digital because stock or shares can't be located, you can't play options, it hasn't had the buy button turned off, and it hasn't had any notable halts. And he says this is such an obvious pump and dump for collateral using a Chinese shell company. So over the last year and a half, we've seen many different companies popping up and pumping out of nowhere, claiming to be a new meme stock, but it's likely that many of these companies have been tied to Citadel or other shorting hedge funds. These funds are obviously desperate for collateral to meet their margin requirements, and therefore they've IPO'd a company out of nowhere, bought loads of shares, pumped the company up or pumped the stock up, and therefore they can recognise this massive unrealised gain as the market cap has risen massively. They can use that unrealised gain to meet these margin calls or to meet these margin requirements, and they can even take out cash loans against these unrealised gains to invest further. And guys, if you haven't already, be sure to sign up to Moomoo right now. Use the link in the description below. You can currently get 10 free stocks worth up to a whopping total of $25,000. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not sell your order flow to market makers like Citadel or to clearing houses like Apex Clearing. In fact, Moomoo clear their trades on their own through Futu Incorporated, which does also not sell your order flow. Therefore, Moomoo is brilliant for buying those AMC and GameStop shares. Now, I think the thing that shows they're so desperate and the reason why they're becoming so obvious with it is because of just how close they are getting to these margin calls. Back in the past with companies like Redbox, like MULN, like DWAC, and all of these other meme stock imitations designed to distract us from AMC and GameStop, they haven't quite had this giant run. Yes, they've risen from $1 or $2 or $5 up to say $10, $20 or $30, potentially increasing 10x. But obviously this here is a company that increased from $17 to over $900 per share. I think at the very tippy top it reached over $2,000. Here is a screenshot showing it at $1,851. In this screenshot it had a market cap of $342 billion, which obviously puts it on the ranking and puts it on the list for being within the top 20 companies in the United States and one of the top 24 or 23 companies in the world. The shorts have managed to create $342 billion of additional margin to meet their margin requirements out of nowhere. And this is part of the reason that I think that HKD hasn't had the buy button turned off and it hasn't experienced any of these trading halts. Because it's being owned 170% by these institutions, by these funds currently shorting AMC. They've obviously decided, guys, we need to pump this company to create additional margin, and we don't want it to be halted. Now this company has run up, now they've made all this additional margin to meet their margin requirements, and now they've managed to buy all of these additional shares for the GameStop dividend to pass it around all of these different brokers. They can then allow HKD to fall after the fact. That's why you see many of these meme stock imitations pumping for a short period of time to create all of this additional margin before then being left to obviously die again. And again, next time one of these hedge funds needs additional margin, they'll IPO a new company or pick a previously dormant or dead company and pump it up again, creating all of this collateral. Every single time they're pumping these companies more and more. First it was 10x, then 20x, then 50x, and now 100x and even more. These hedge funds are getting so desperate, more and more desperate and more obvious because it shows just how close to a margin call these companies really are. Medium.com actually wrote an article on what comes next for the GameStop dividend. And they said due to a number of complaints currently being filed with FINRA and the Investor Relations Department of GameStop over the last couple of days, many are expecting GameStop to make a press release on the matter. As I was saying the other day, Ryan Cohen and GameStop can now issue a share recall if they want, if they discover the DTCC hasn't followed their instructions. It says the company was clear on their intended actions in the IRS Form 8937, so shareholders are having a difficult time understanding why a different action was taken by the DTC. While stock splits distributed via dividend are not common, the DTC successfully completed similar corporate actions for Tesla in 2020, Nvidia in 2021, and Google in 2022 with no issues. And as of the 2nd of August, the largest securities enforcement agency in Germany has been the first to make a statement. They stated GameStop shares have been improperly booked and that a stock split distributed by dividend should have taken place. They're currently working to rectify the situation with the DTC due to German brokers originally handling the action as a stock split. Clearly these hedge funds and the DTC have messed up and they've exposed true crimes once and for all. These hedge funds are also becoming more and more desperate and again more and more obvious, exposing their true crimes by pumping up new companies like HKD. And I think all of this has really stemmed from over-leveraged investing by these hedge funds. This article from FN London says a London hedge fund scrambled as their bet on high-flying stocks went wrong. Macho Partners, which had over $1 billion in assets under management at its peak, was down nearly 84% in the first 6 months of this year. And that marks one of the worst known performances for a hedge fund so far in 2022. And this is behind the dismal results was a leveraged bet on a relatively small number of high-flying growth stocks that have plummeted in value. And the exact same thing is happening to these risky hedge funds shorting companies like AMC as well. They've made leveraged bets not only on the long side on different tech companies, but also on the short side with AMC and GameStop. As AMC continues to rise, these leveraged bets turn against them more and more, and as the wider stock market continues to fall again, these companies or these funds end up worse and worse off. And these leveraged bets are effectively what got these hedge funds into this mess in the first place. If their original investments or their original short positions weren't heavily leveraged, they were just regular investments and regular shorts, they wouldn't have lost such massive portions of their portfolio, they wouldn't be facing bankruptcy, and they wouldn't have to take such drastic action. If their entire fund wasn't about to go bankrupt, they wouldn't have to be committing these illegal crimes, and they wouldn't have to be exposing these illegal crimes as well. And speaking of highly leveraged funds, these pension funds that have been investing in these heavily over-leveraged hedge funds are also losing billions and billions of dollars. CalPERS has just unloaded a record $6 billion of private equity stakes at a massive discount. The pension giant's massive sell-off aims to free up cash for new wages. But it seems like some of these pension funds or some of these hedge funds aren't learning their lessons. They're selling off heavily over-leveraged investments in private companies to make more investments. And this, I think, is the worst part of all of this. It's fine for hedge funds to lose their own money, it's fine for hedge funds to lose the money of high net worth individuals, but it's not fine for hedge funds to lose the money of public employees' retirement systems. When the money of public teachers and public employees is used to bet against American companies without their knowledge, and massive amounts of funds are lost, billions if not trillions of dollars ends up being lost, it's just unfair on those public employees. But I do think this whole escapade is coming to a close. The fact these hedge funds are now becoming more obvious in their crimes and are messing up left, right and centre, I think it just goes to show how close the squeeze really is. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.